Larry Fink just sent a message that every serious investor in the XRP ecosystem needs to understand completely, and it is not the price prediction version of this story that you are going to see on most channels today. The CEO of the world's largest asset manager, the man who controls $14 trillion in assets under management, just published his annual chairman's letter and placed tokenization at the absolute center of it, not as a footnote, not as a speculative aside, as the primary structural thesis about how global finance is going to change. And the comparison he chose was precise and deliberate. He compared tokenization to the internet in 1996, not 1995, not 2001, 1996, specifically the year the Telecommunications Act passed, the legislation that built the legal infrastructure for everything the internet became over the following 2 decades. That comparison is not hype. It is a framework from the most credentialed institutional voice in global asset management. And tonight we are going to break down exactly what it means, why the 1996 parallel is more precise than most people realize, what it tells you about the timeline for tokenization's impact on XRP specifically, and why the combination of Fink's letter and the regulatory infrastructure we have been covering on this channel is the most coherent bullish case for this asset that has ever existed simultaneously. There is a specific passage in Fink's letter, the digital wallet paragraph, that I want to walk you through carefully because the implication for XRP's utility case is more direct than the headline coverage is capturing. Stay for that. Before we go further, this is not financial advice. Nothing in this video is a recommendation to buy, sell, or hold any asset. This is educational analysis of publicly available statements and institutional research. Always do your own research and consult qualified professionals before making any financial decisions. If this is the kind of institutional-grade breakdown that connects what the world's largest asset manager is saying to what it means for your XRP position, hit the like button now before we start. It is the fastest signal you can give the algorithm that this content deserves a wider audience. Subscribe with the bell on because Fink's letter is the opening statement of what is going to be a major institutional narrative cycle in 2026, and every development in that cycle gets covered here as it happens. Let's build this. Start with who Larry Fink is and why the annual chairman's letter matters, because the weight of what he said is entirely a function of the institution behind it. BlackRock manages $14 trillion in assets under management as of the end of 2025, with nearly $700 billion in new assets entrusted to them in 2025 alone. That is not a hedge fund. That is not a crypto-native firm with a vested interest in promoting digital assets. That is the single largest institutional asset manager in the history of global finance. The firm that manages retirement savings, sovereign wealth allocations, pension fund capital, and endowment portfolios for institutions across every major economy on Earth. When Fink writes his annual chairman's letter, it is read by the boards of those institutions. It shapes how the largest pools of capital on the planet think about where the world is going. And this year, the primary structural theme he chose to anchor that letter around was not AI, not geopolitics, not interest rates. It was tokenization. He wrote that tokenizing stocks, bonds, and ETFs could democratize investing the way the internet democratized information. He described digital wallets, which half the world's population already carries on their phone, as potentially becoming investment vehicles as easy to use as payment apps. And he positioned BlackRock with its $50 billion in digital asset AUM and the world's largest tokenized fund at what he called the intersection of forces reshaping global finance. That is not a casual remark from someone warming up to the idea. That is the definitive institutional positioning statement of 2026, published by the person with the most credibility and the most capital behind it of anyone on Earth. Now let me explain why 1996 specifically, because the precision of that comparison is what makes it analytically useful rather than just rhetorically powerful. In 1996, the internet existed. The technology worked. Email was functional. Early websites were live. But the majority of the value that the internet eventually created had not yet been captured by markets, by businesses, or by individuals, because the legal and infrastructure framework for commercial activity on the internet was still being assembled. The Telecommunications Act of 1996 was the legislation that resolved the foundational ambiguities about ownership, about access, about competition, about who could operate on the network and under what rules. Once that framework was in place, the institutional capital that had been watching from the sidelines, the serious money that needed regulatory clarity before it could deploy at scale, began moving. And between 1996 and 2001, roughly 5 years, the market capitalization of internet-related assets expanded by orders of magnitude. Now apply that framework to where tokenization sits today. The technology works. The XRP Ledger processes $1.73 billion in monthly stablecoin volume. RLUSD is doing 11 billion in monthly transfer volume with 149% month-over-month growth. The infrastructure is operational. But the regulatory framework that allows institutional capital to deploy at full scale, the equivalent of the Telecommunications Act, has been assembling piece by piece throughout the past 12 months. The FDIC's proposed Genius Act implementation rule treating stablecoin deposits identically to traditional bank deposits. The joint Fed OCC FDIC clearance for banks to hold tokenized securities. The SEC CFTC joint final rule classifying XRP as a digital commodity alongside Bitcoin. These are the regulatory infrastructure pieces that Fink's 1996 analogy is pointing toward. We are at the moment when the framework is coming together, not when the value has already been captured. And Fink's letter is the signal from the most credible institutional voice possible that the serious capital is beginning to price in what comes after the framework is complete. Here is the specific passage that has the most direct implication for XRP, and I want to walk you through it carefully because the mainstream coverage of this letter summarized it in ways that missed the specific mechanism. Fink wrote, "Half of the world's population carries a digital wallet on their phone. Imagine if the same digital wallet could also let you invest in a mix of companies as easily as sending a payment." That sentence is not abstract future gazing. It is a description of a specific technical architecture, one in which the same infrastructure used for payment settlement is also the infrastructure used for investment asset custody, transfer, and settlement. That is not the architecture of Ethereum gas fees and 5-minute confirmation times. That is the architecture of a ledger that settles in 3 to 5 seconds at fractions of a cent. The architecture that RLUSD was built on, and that the XRP ledger was designed to provide at scale. Fink is describing a world where payment infrastructure and investment infrastructure are unified. That is the world where the XRP ledger's throughput, settlement speed, and cost structure are not secondary features. They are the foundational requirements. And the CEO of the firm managing $14 trillion just told every board of directors, every pension fund committee, and every sovereign wealth manager reading that letter that this is the direction global finance is moving. That is not a retail social media moment. That is an institutional positioning signal of the first order. Comment 1996 below right now if the parallel between the Telecommunications Act and the current regulatory infrastructure build, FDIC, OCC, Fed, SEC, CFTC, landed for you the way it landed for me when I read Fink's letter, because that parallel is the analytical frame that makes this moment readable. Now let me connect the Fink letter to the current market environment, because you deserve the complete honest picture, not just the bullish case. The macro environment right now is genuinely complicated. The Iran-US conflict has pushed oil to 103 per barrel. Equity markets have been volatile. The Clarity Act timeline has slipped toward July and possibly beyond. XRP is trading 63% below its 2025 high. Short-term price behavior has tested the patience of every holder who entered above current levels. None of that contradicts the Fink thesis. In fact, it is precisely the kind of environment in which institutional positioning happens, during the periods when retail patience has been exhausted and headlines are dominated by fear-driven narratives rather than infrastructure developments. The pattern that repeats across every asset class and every technology cycle is consistent. The institutions that benefit most from the expansion phase are the ones that built their positions during the period when the technology worked, but the framework was still being assembled and the crowd had not yet arrived. That is the period Fink's letter is describing. And it is the period the FDIC proposed rule, the OCC implementation, and the SEC CFTC joint final rule are collectively marking as the assembly phase of the framework. The people who understand that distinction, who can hold a position through the framework assembly period because they understand what is being built, are the ones who are positioned ahead of the institutional wave rather than chasing it from behind. Here is the investment psychology piece, because the comment sections of XRP channels right now are full of people in exactly the emotional state that has historically preceded significant market moves, and I want to address it directly. Impatience after a prolonged consolidation period is normal. Frustration when short-term price action does not confirm a long-term thesis is normal. The temptation to interpret the absence of visible price movement as evidence that the thesis is wrong is one of the most consistent cognitive failure modes in investing history. The people who exited XRP during the SEC litigation period, convinced that the regulatory headwind was permanent, watched the subsequent commodity classification and ETF approvals from the outside. The people who are exhausted by the Clarity Act's slipping timeline are making decisions based on one legislative variable in a framework that has already produced multiple agency-level regulatory advances that do not require clarity to function. Fink's letter does not mention clarity. It does not mention any specific legislation. It describes a direction, the direction in which the largest pool of institutional capital on the planet is moving, and it describes the infrastructure that direction requires. That infrastructure is being built. The timeline is longer than many people hoped, but length of timeline is not the same as absence of direction. And every serious long-term investor in technology cycles, from the internet in 1996 to mobile in 2007 to cloud in 2012, has had to hold that distinction clearly during the assembly phase when the crowd has not yet arrived. Here's the complete picture. Larry Fink, CEO of BlackRock with $14 trillion in assets under management, published his annual chairman's letter and placed tokenization at its center, comparing it explicitly to the internet in 1996, the year the Telecommunications Act provided the legal infrastructure for the internet's institutional adoption phase. BlackRock manages $50 billion in digital asset AUM and operates the world's largest tokenized fund. The regulatory infrastructure Fink's 1996 analogy is pointing toward FDIC Genius Act implementation, OCC proposed rulemaking, Fed OCC FDIC joint tokenized securities clearance, SEC CFTC digital commodity classification, including XRP, has been assembling across the past 12 months in exactly the sequence that the internet's framework assembled between 1995 and 1997. RLUSD is processing $11 billion in monthly transfer volume with 149% monthly growth. $851 million of that on the XRP Ledger specifically. The framework is being built. The institutional signal from the most credible voice in asset management has just been published. The current price reflects a market that is not yet fully priced in the convergence of those two facts. That is the honest, complete, institutional grade case, not a price prediction, a framework for understanding the moment we are in. If this connected the Fink letter to the regulatory infrastructure and the RLUSD data in a way that gave you genuine analytical clarity, smash the like button. You stayed for the full breakdown, including the digital wallet paragraph analysis I told you to hold for, and that tells me you are thinking about this at the right level. Share this with one person in your network who is feeling the frustration of the current consolidation period, because the 1996 framework is the context that transforms frustration into informed conviction. Subscribe and hit the bell because Fink's letter is going to generate institutional responses and follow-on announcements throughout the coming weeks, and every meaningful development in that narrative gets covered here immediately. Tell me in the comments, which regulatory development from the past 12 months, FDIC, OCC, SEC, CFTC joint rule, or the Genius Act implementation, do you think is the most undervalued by the retail market right now? I will see you in the next one.